For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about this week's economic and market news that matters to retirees. We'll also discuss 8 retirement myths that could cost you thousands, and then should retirees take less risk, but not too much risk? My name's Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jake Floyd of Floyd Financial Group. Hey, Jake, how you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. I hope our listeners are having a great summer weekend here in the Ozarks. As always, we're really glad you could join us here each and every week for Show Me the Money. Jake, this week could be one of the biggest weeks of the summer for investors. There are a lot of important economic reports that are coming out. Inflation is back in the spotlight. The Fed seems to be sending mixed signals. So, Jake, let's start with the big picture. What should retirees and people close to retirement really be paying attention to right now?
Man, that's a really good question. I think probably the biggest thing, if we were going to point to one thing right now, is probably inflation. Because inflation has the potential to send this whole thing crashing down. But if we keep inflation under control, I think the growth of the entire global market, but definitely in the U.S., is going to really propel things higher. And if we have a strong market, it's hard to get into too much trouble when it comes to retirement. And it can cover up for a lot of mistakes that people make sometimes in their portfolios. And maybe you're withdrawing more money than you should. If the market's kind to us, you can get away with that. And so I think if we were going to pick one thing that we were going to pay attention to, I would say it's probably inflation. And last week, we had the new Fed Chair Warsh was on. And again, like Randy, I still almost giggle at myself every time I say that because of the, in this area, a lot of people say wash when they're washing their clothes or their car or whatever. So
I grew up with that. We're going to wash the car. We're going to wash the clothes.
So he was testifying on Capitol Hill. And he actually promised that inflation, what was his actual words here? It said, inflation is a thing of the past, is what he said. Now, that's a very bold statement from something that is kind of under his control, but kind of not. What I would say is it speaks to his intelligence and his understanding of markets, his understanding of economies of scale. He understands that AI is going to be hugely deflationary. So to make a statement like that is less about his ability to manage the Fed and more to say that we're just not going to have inflation because there's going to be so much deflationary pressure due to AI, artificial intelligence, agentic AI, all these different things ultimately are going to drive deflation. And I think there's a lot of people that may be going, what? What are you talking about? So let's talk about that for a second. The reason AI will be deflationary in many ways. There's a few ways it will be inflationary, and I'll cover those too, but the main way AI is deflationary. Let's say that you make a product. It doesn't really matter what that product is, but it's some kind of consumer item. And you sell that product for $1, and it costs you 70 cents to make it. Yeah, that other 30% is in your pocket. So AI comes along, we add some robotics to the warehouse to make your product, and we fire some of the workers, and all of a sudden now it only costs you 30 cents to make your $1 product. So you're laughing your way to the bank, right? Maybe not so much. It depends. Depending on that environment, you probably have competitors. So competitor company B comes in and says, hey, he's making way too much money. I'll make it cost 30 cents to make. 90 cents is what it costs to sell it now. And so company A comes back and says, whoa, you're not going to take my customers. I'll make it for 80 cents. And pretty soon you're selling it for 40 cents, making it for 30 cents.
Right.
That, my friend, is deflation. And that's going to happen to a lot of consumer products around the globe. I think that Kevin Warsh understands that in a way that many people do not.
Yeah, and that is interesting. I was going to ask you, how does AI affect inflation? But that's a very good explanation. Right now, as far as I know, in the last couple of weeks, Jake, it's turned around a little bit. It was like 4.2% the last time I looked. Now it's under 4%.
Yeah, and so that's almost entirely due to oil prices. Mm-hmm. So oil prices went crazy in March, right? And we went from I think it was in January, we were at $59 a barrel or something. We went
Right.
to about 123 at the highest point, and we were back under 70 there briefly. And then we had, over the last couple of weeks, more tension with Iran. We got back up over 80. So I think that the inflation numbers are entirely, at this point, a factor of just the price of oil. And so if you actually consider how much oil moved versus how much the inflation numbers moved, what it would suggest is that we actually are seeing deflation everywhere else, because prices should have been up more than they were based on the fact that oil doubled almost overnight.
And correct me if I'm wrong, Jake, but the oil price really does affect many other things that we buy because of the transportation cost. So if the price of a barrel of oil goes down, it sort of trickles down into almost everything else. Is that a fair statement?
I would say you don't even have to qualify it. I would say it absolutely travels down into everything. So if you think about some product that you buy at Walmart that came from China, right? It had to have fuel to get shipped over here. That inflation, though, also gets priced into the worker's salary because they have to pay more for that item, and therefore they have to have more money to live. And so the price of oil is, I mean, I can't think of anything else that's more important to inflation and the price of everything than the price of oil. And it's a really big deal. And some of these reports, they're like, well, if we back out the price of oil, then that means inflation was only X number. Well, how can you possibly back out the price of oil? I mean, it's so deep-seated, 3, 4, 5, 6, 7 layers into everything. And it goes through a second time because it costs so much to get it from China and because the worker had to make more money. And then it circles back around to, hey, now the worker has more money and we're going to, so we can charge more to ship it from China. It's never ending. So it's exponential in nature because it travels so many times through the economy.
Talking with Jake Floyd of Floyd Financial Group today, and we're talking about this week's economic and market news that matter to retirees. And of course, we've been talking about inflation. If our conversation piques your interest a little bit, you'd like to come in and sit down with Jake, have a little discussion about your retirement plan. Certainly, it's going to be no cost and no obligation and no judgment. If you'd like to take advantage of the opportunity, 417-889-7233 is the number to call, and you can make that call this week. And if you want, leave your name and number. Ashley will call you back during the week and set up that little chat for you. It's 417-889-7233. And as always, you can find out more about us online at floydfinancialgroup.com. Jake, one thing that surprised investors was hearing that another interest rate hike hasn't been completely ruled out. I thought we were finished with rate increases.
Well, Jeff, I think we're going to see at least one rate hike, maybe even 2 rate hikes. And I think some of that is because Warsh is going to have to get his bluff in on the market because he has to show that he's not Trump's puppet because half the country thinks he is. And I think, frankly, Trump will give him his blessing to do whatever he thinks he needs to do. But he may publicly denounce it, Trump, when they do raise rates. I do think longer term, we will see the cutting of interest rates. But in the short term, we could see 1 or 2 rate increases. If we go much past that, the savings rate will be so attractive that people will start yanking their money out of the market. Capital markets will start to have trouble. So if that starts to happen, then the next natural course is to do what? Lower interest rates. So I feel like we have a ceiling on us, maybe 1 or 2 hikes higher here. That being said, it's okay to have interest rates where they are. It's not killing us. I know there's a lot of people that like to buy a house and that kind of thing. But these are like to things, not have to things. We live in such a different world than we did in 1985, where your life's goal might be to aspire to someday put 20% down and buy a house. Not, I'm entitled to that when I turn 18 and move out of my house. And I think that there's a lot of people taking for granted what they have. And then there's a lot of other people with their hand out going, hey, I was promised the American dream. No. You earn the American dream.
Right.
So I have a little hard time feeling sorry for everybody. Now, I will say this. There are people that are hurting, and there are people that are having a difficult time making ends meet. But I think a lot of those people are on Social Security. And if you're finding it difficult out there right now, it may be because you need a career change or you need to work a little harder, or heaven forbid, you might have to do something that you don't want to do. And that's the way of the world. And I think there's a lot of, especially people that are 20 to 30, even 40 years old, that are somehow with their head in the sand thinking that they don't have to do those things and they don't have to have responsibilities and that kind of thing. And I think this next 10 years is going to wake them up.
Jake, I know what you're talking about. I think the younger generation many times, and now I'm sounding like an old guy. I mean, sometimes you've got to do what you've got to do, whether you want to do it or not. It's what do I have to do versus what I'd like to do. And when it comes to making a living and supporting other people, just becoming a good citizen, sometimes you have to do some things that you do not want to do. And another thing that you talked about, Jake, is higher interest rates aren't all bad, especially for retirees. There are some positives in terms of money market funds and treasury bills and CDs and short-term bonds and so forth. Let's talk about the labor market here. Employment has cooled somewhat, but unemployment is still relatively low. Is that a good sign?
One of the things, not to get sidetracked here, but a few weeks ago, one of the things Kevin Warsh said that everybody was up in arms about is he said, basically the data we've been getting is a bunch of crap. And I mean, he didn't say it in those terms, but basically the data is cooked and it doesn't represent real data. I would say that could not be any truer for any data more than it is for the unemployment rate. There's unemployment rate, there's underemployment rate. How they calculate whether you're unemployed or not is based on how long you had a job, whether you should be in the workforce. There's so many different calculations and different ways that they do it. I remember back in 2008 that when they wanted to cook those numbers to make them sound less bad, they would change the calculation. When we actually had real unemployment running in the 13, 14% range, they would change the way it's calculated to get it down to like 8%. And so I think that the numbers are kind of cooked on that. And one of the things he wants to do is reset that and fix it so that these numbers actually mean something. I mean, there is no way that we have an actual only 4% unemployment rate. I mean, I know lots of people that are unemployed for various reasons, right? Yep. It is not 4%. 1 in 25 people are jobless. No way. It's way higher than that. So how we calculate that probably needs to be more transparent and more reliable. And I do think we're going to see the unemployment rate climb as people get laid off. However, it depends on how we see those people as far as, are we including people that are actively looking for a job and people who have stopped looking, or we just don't count those people anymore because they're on the Medicaid train or on the SNAP train or whatever. To your point, I think that we are going to see unemployment start to rise, but we may also see it somewhat of a reset in how the data is calculated, and we may not be able to compare the current numbers with old numbers because they may be more accurate looking forward.
Great conversation, Jake. I do want to continue this in the next segment here. If today's headlines have you wondering whether your retirement plan is really prepared for what's ahead, don't wait until the next market drop to find out. Here at Floyd Financial Group, we're going to help you understand where you stand, identify potential risk, and show you strategies that can help protect your income, reduce unnecessary taxes, and give you greater confidence about your financial future. Your first retirement review is completely complimentary with no obligation, and you can take advantage of that opportunity right now by calling us at 417-889-7233. It's 417-889-7233. Again, it's just a casual conversation with Jake here at Floyd Financial Group. There are no topics off limits. If you want to talk about when to take Social Security, that's not a problem at all. Maybe you've got some money in a 401k. You want to convert it into an IRA, see what your options are. You don't want to run out of money before you run out of life. I mean, basically, we can talk about almost anything here. A confident retirement plan doesn't happen by accident. It happens with a plan. To get your plan, once again, it's 417-889-7233. We're also online at FloydFinancialGroup.com. Jake, it is time for a break. When we come back here on Show Me the Money, we're going to continue to talk about world events and current events when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shane.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking more about current events, earnings season, SpaceX, and more.
And we've got a lot to talk about today, Jake. I want to continue this conversation by talking about the stock market. It has had another tremendous run this year, largely led by artificial intelligence companies. Should retirees really be chasing those returns?
It's a good question, Jeff. I'd say some of that depends on your time horizon. If you're looking to spend this money in the next few years, I think chasing here can be dangerous. But I do think that most of these companies will end up going much higher in the long term. The question is, how much liquidity do you need? How much access to your money do you need? And you don't want to have to be reaching in to spend money whenever we're having one of these dips, because I think AI is going to have many, many 10, 20, 30% corrections over the next 6 or 7 years. But ultimately, I think it's going to go much higher. I do think that we're starting to get a little long in the tooth in certain areas like the memory shortage. So this is Micron, SanDisk, and now SK Hynix, which is the new Korean company that just debuted last week. I think those are a little bit overblown. They're making huge amounts of money, but if they're not careful, they're going to get a couple competitors in there and kind of take them out. So I'm not really wanting to chase stuff that's up 1,000% year to date, or over the last year. That's pretty crazy. But I do think there's a lot of companies in the AI race that are fairly cheap. I think Meta is super cheap. And I think we're going to see Meta take another big run here at some point. I think Amazon is being discounted. So these are Mag 7 names. Amazon is actively building their own chips. They have all kinds of things going on behind the scenes. But some of these companies are just so big, too, that people are concerned to run them up too much. I think NVIDIA is probably the best example of that, where NVIDIA is on a 2,000% run or something over the last 2-3 years, and it's now a $5 trillion company. So if NVIDIA was any other company trading at 23 times forward earnings and growing at 67% year over year, the company would be trading at like 100 times earnings or more. But because it's such a behemoth, it's hard to get those bigger multiples. So back to your question, I think that AI is expensive, but it's going to get a lot more expensive. You hear the old adage, buy low, sell high. I think the game looking forward is going to be buy high, sell higher.
Jake, I want you to help me understand AI a little bit, and hopefully for our listeners as well. When I think of artificial intelligence, I think of ChatGPT. A lot of people use that, and also maybe Google Gemini to some extent. But what you're talking about are some of the businesses that support those platforms and how important they are to the success of things like ChatGPT and Google Gemini. Is that what we're talking about here?
Yeah, so in my opinion, and this is a little bit of a, as the kids would say, a hot take, I think that the actual AI companies are not going to be the ultimate winners, meaning the ChatGPT, so in this case, OpenAI, Anthropic. I don't think those are the companies that are going to win long term. I think they're going to do okay, but the companies that are really going to win are the ones that are building out and charging for those services to be run. The hyperscalers, again, some of the companies we've already mentioned, but then also companies that utilize AI to decrease cost in their business are also going to be big winners. They're not tech companies. They're just simply using tech to their advantage. Like a telemarketing firm, for example. If you have a telemarketing firm, and that may not be as good an example because some of AI may just totally replace that, but if you have a business that can be, maybe you run a journalism outfit, and one person can now do 5 times the work they used to be able to do because they have ChatGPT assisting them, and they don't have to physically type everything out. It knows who they are. It knows how they write, and they can give it a few tips and write the article, check the article, and boom, it's done. Now you don't have to pay 5 editors, right? You just pay 1 for every 5 you used to have. Companies like that are able to just slash costs, even to an extent, Amazon, Walmart, companies that have tons and tons of employees. Walmart's the biggest private employer on planet Earth, employ over 4 million people. If they cut 10% of the workforce, they're cutting tens of billions of dollars of cost a year. Those are companies that are really, I think, going to win long term, are the ones who are able to utilize AI, not so much the ones that are creating the technology itself.
Jake, let's talk about employment again. I mean, with AI cutting all of these jobs, I know, Trevor, your son is, he's an early teenager. What would you suggest that people do who are doing jobs right now that may be replaced by AI? What's the future of employment, I should say, basically?
Man, that's a good question. And there's been a lot of people saying this, and I agree that I think we're going to see a transition back to trades that cannot be done by AI. When I was younger and I was getting ready to go to college, my parents wanted me to go to college to go to business school. And they didn't want me to become a plumber or a welder or an air conditioning tech. But those are the businesses that are not going to be supplanted by AI.
Yeah.
We also are going to have a major shortage of those things as the current generation retires. I don't know how many welders you know. We have quite a few welders in this area. The problem is a lot of the great welders and a lot of the people that have 30 years experience are now 65 years old. They're looking for the exit. And I don't know that there's anywhere near enough people ready to replace those people, especially with their skill sets. Welding specifically is kind of an art form more than it is a science. And robotics can do it to a certain extent, but the reality of welding, for example, if you have a perfect fit up on what you're trying to weld, a robot could easily weld it. But how often is that the case, even with very premium materials? Almost never. I know that's a little technical, but any welders out there will be able to appreciate what I'm saying. And I think that's true of all the trades out there. A robot's not going to crawl under your house and fix your flooded basement. I think having a little bit of entrepreneurial ability coupled with 6 months at a trade school, if you want to be a plumber or an electrician, getting under there and start apprenticing, I think you'll be able to write your ticket. I think those places, you're going to be making way more money than a generic business degree over the next 10 or 15 years.
And I agree completely. I've got plumbers and electricians on speed dial here, and I use them all the time. And think about this. You go to a trade school for 6 months, you apprentice, you're basically in business here, probably less than a year, and you've got no student loan debt. I really think that is the way to go. Let's continue to talk a little bit about what's going on in the market. Jake, SpaceX has been a big buzzword here the last couple of weeks or so. And a lot of people think that SpaceX, well, they're just shooting rockets off into space. Why should I invest into something like that? But SpaceX is a lot more than just shooting rockets, isn't it?
Yeah, I would say that the space travel, going to Mars, even going to the moon aspect of SpaceX is definitely not the reason to invest in it. And I think there's a lot of people around here that think that that's why people are investing in SpaceX. So SpaceX is basically two things right now. Number one, it's Starlink. And if you didn't know what Starlink was 6 months ago, you probably do now because of the relentless ad campaigns they're doing everywhere, including here on the radio. We saw it on FIFA and all the different sporting events. Starlink's a sponsor of everything. So Starlink, you probably know what it is, but it is, kind of an internet everywhere via satellite scenario. SpaceX has been systematically launching these Starlink satellites for 8 years. I could be wrong on that. 6 to 8 years, somewhere in there. And they have something like 23,000, I think, in orbit right now, with an ultimate goal, I think, of 32 is where they're going to stop. But they basically have 23,000 satellites that circumnavigate the globe in space, in orbit, that provides internet anywhere. So you can now get internet in sub-Saharan Africa if you had a device to get it on. He's aided several major war efforts with it, all this kind of thing. There are no real competitors. Amazon eventually wants to be a competitor, but they're not even remotely close at this point. So Starlink is a big one. And then SpaceX on the other side of it is an AI company. People don't really see it that way. I think the average person who's not in the industry doesn't see it that way, but there's two components to the AI business. Number one, the big one, the one that everybody's really trading on at this point, is putting data centers in space. So nobody wants a data center in their backyard. They don't want the extra power usage. They don't want the water waste. They don't want any of that. So the easiest solution, I say the easiest with air quotes, right, is to put it in space because you get free energy, you have no water usage. And if they can figure out how to cool things in space, because you cannot radiate heat away in space the way you can here because you're in a vacuum. And so the heat kind of sticks to the chips and everything. But if they can figure that out, and Elon seems incredibly confident that within 12 months they are going to have it, they're going to be launching these. If that's the case, he will have the single thing that everybody wants and that nobody else can have. He has the ability to launch these with a 10-year head start on any possible competitor, and he has the only means to beam down the information afterwards, which is Starlink. So I really think that the potential is so large that you cannot afford to not be invested in SpaceX, simply because it could be higher than anybody is even saying. And there's people calling for 20 trillion market cap on SpaceX, which is almost 20x from the level we're at right now. I personally don't think that's too ambitious. I think that if they are able to do some of the things that they're trying to do, I don't even think they need to do all the things they're trying to do, but just some of them. And again, people have a history of going bankrupt betting against Elon. I would say that provided Elon survives, it's likely to go that direction. Now, I do want to say a couple things about that because a lot of people are wondering why, especially my current clients are wondering why I didn't buy more SpaceX on day one. We went out, we bought a little bit, but everybody was kind of chomping at the bit. They're like, I want more of this. I want more of this. And I was like, we need to be a little careful. There's a few quirky things about SpaceX. And the main thing is their lockup expiration. So when a company goes public, the insiders, the people that work at the company, generally can't sell for 6 months. With SpaceX, they have a tiered lockup expiration, partially because so much of it's owned by insiders. It's something like early investors and insiders are about 96% of the total stock's market cap. You have a lot of people at SpaceX that are making $150,000 a year, but they're worth nearly $100 million worth of stock. And so as soon as those lockup periods expire, and they're much sooner than the 180 days, these people are going to sell like crazy, and that will probably push the stock lower. We bought a little bit day one just in case I was wrong and this thing was going to go just crazy high. But I really think we may get an opportunity to buy SpaceX under 100. And I said that to clients when it was 220 a couple of days after it launched, and here we are in the 130, 140, 150 range. I don't know if it'll go under 100. It might, but I think that as these lockups expire, there's going to be a lot of selling of people that need the capital. I think that's when we want to scoop it up. So the question is not if we want to own SpaceX, it's what we have to pay for it.
Jake, that was a great explanation about SpaceX, because I think on the surface, a lot of people just see the rockets shooting off into space, and it's really just a lot more than that. And people really want to get in on the ground floor of the new Apple, but Apple didn't take off right away. It took a few years to do that, 5-10 years, didn't it?
Yeah, so I think before SpaceX will really, really take off, it's going to have to start printing money. And I think we're still a little ways out from that, where SpaceX is making money and they have quite a bit of revenue. In fact, most of their revenue right now is coming from data center rent out. So SpaceX owns a bunch of NVIDIA's Grace Blackwell chip stacks, and they're renting them out to OpenAI and to Anthropic to the tune of like $15 billion a year. That's about double what the revenue and everything on Starlink is. So, however, I think that most of this money is going to get spent as soon as it comes in on endeavors that they're trying to complete. It'll probably take 5 to 7 years to see the really big numbers, but there can be some things that accelerate that. And I think rather than trying to play with fire and trade around it and that kind of thing, is we wanted to buy a little bit, and then as it's coming down, we want to buy a little more. And if it really comes down, then we'll want to kind of back the truck up, as I like to say.
Jake, great conversation. I do want to wrap up by talking about the World Cup a little bit. And we see people coming here from Europe and other continents, and they're saying, wow, we love it here. That is not exactly what we're used to seeing, is it?
Well, I think a lot of the media out there, the legacy media, would have you believe that Europe hates us. And I do think there is some disdain for America, for Trump, for all of it to an extent. But as people have come over here for the World Cup, they kind of look around and they're like, wow, this is kind of a nice place. We thought this was all lies that they were telling us from the other side of the pond here to make us believe that it's great in America, and it really isn't. And, it really is great here. There's been lots and lots of videos of people posting and saying things like, if I was American, I would throw away my passport because I don't need to go to another country to go to the beach or go to the mountains or go to the desert or go to the forest, right? You can do all that inside the United States. But there's been a lot of unity on the world stage and camaraderie than most people would have expected.
Talking with Jake Floyd, Floyd Financial Group, we've been talking about economic news and all the other things that retirees and pre-retirees should be interested in as far as the future of their retirement goes. And if today's headlines have you wondering whether or not your retirement plan is really prepared for what's ahead, well, you can get some answers to that by calling 417-889-7233 and requesting your Floyd Financial Group financial review. Absolutely no cost, no obligation, and no judgment. It's 417-889-7233. If you'd like to sit down and have a casual conversation with Jake about your journey towards a confident retirement, we're not going to charge you a dime for that. Again, it's 417-889-7233. We're also online at FloydFinancialGroup.com. Jake, let's take a break. When we come back here on Show Me the Money, we're going to be talking about 8 retirement myths that could cost you thousands when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about 8 retirement myths that could cost you thousands.
And Jake, one of the biggest challenges that retirees face today isn't always the stock market, it's misinformation. Everyone seems to have an opinion about retirement, and friends and family and coworkers and social media. Everybody is chipping in on this, even complete strangers. Unfortunately, some of those opinions are actually myths that could end up costing people thousands and thousands of dollars. So, Jake, probably the most famous retirement rule ever created is the 4% withdrawal rule. Is that really a magic number for everyone?
So it's more of a guideline than a rule. And I think that the 4% rule gets a lot of attention. And I think that what's more important when we're talking about not running out of money is your asset allocation, meaning, to oversimplify things, how much of your money is safe, how much of your money is diversified, how much of your money is at risk, how aggressive we are with these things, how correlated our investment strategy is. Those things have more to do with you running out of money than a simple, here's how much money I'm taking out. Your timing in the market has more to do with it than here's how much I'm taking out. That being said, I do think if you follow the 4% rule, you withdraw 4% of your assets and you maintain a moderate to moderate aggressive portfolio, you're likely going to be just fine. However, you have to be willing to commit to that strategy. You have to stay in that strategy. You have to not get cold feet. You have to not bail if the market goes down 30, 40, 50% like a 2008. And that can be more difficult than you might imagine when you watch your only pool of money once you retire start to dwindle. So I think having some safeguards in place is probably the most important part when it comes to figuring out how much money you can take out of your portfolio. I will tell you that a lot of times we are more like the 5% rule, but we also add a fair amount of safety into most people's portfolio, because the biggest enemy you have when you go to retire, especially if you have about the right amount of money saved. If you have way more money than you need, that's different. If you don't have enough money, that's different. But if you have about the right amount of money saved up for retirement, your biggest enemy really is taking a big loss. And so if we can take that off the table, that's a win.
So myth number one, busted, is the 4% rule is the amount of money you can take out to keep you sustainable through retirement. It just depends. Myth number two, Social Security is going bankrupt. This myth creates a lot of anxiety, Jake. People hear Social Security is going broke around 2032, something like that, so they rush to claim benefits as early as possible. Many times not the best idea.
Jeff, I think that this is probably the one that comes up the most in my office. I think almost everybody is convinced it's going to go bankrupt. Again, another take that a lot of people probably won't agree with, and that's okay. I don't think Social Security is going away. In fact, I think it's going to get expanded. As they go to fix, quote unquote, Social Security, first of all, I think they're going to delay this as long as humanly possible, and we probably won't have a real discussion about fixing Social Security until 2032 during the presidential election, because it's political suicide to talk about it. We can look at Chris Christie's resume for examples of that, because he's about the only one that's suggested cutting Social Security, and his approval rating is insanely low. I really don't think it's going away, because I think Congress is going to be greedy and self-interested, and they will use it as an opportunity to expand Social Security to buy votes. So if you're laying awake at night worried about Social Security, remember that even if you think these people are evil enough to do that, which I'm not saying they're not, you have to understand that they want control. They don't want chaos. And if they were to just yank Social Security out from under everybody, it's going to make people too desperate and they will lose control. So I would not be worried about Social Security going away. There's plenty of things to worry about in the world, but this isn't one of them.
Yeah, 2032 is the number that I've heard a great deal, but what I've also heard is that if nothing is done, that Social Security benefits may be reduced by 75%. But I think if you're already getting Social Security or you're close to getting Social Security, that there will be no change. Let's continue now with these myths here. Cash is the safest place for retirement money. When markets become volatile, people say, I'm moving everything into cash, and it sounds pretty safe, doesn't it?
Yeah, there's an old saying on Wall Street that says cash is trash. And people are like, what? What are you talking about? What that means is if you hold cash, inflation will slowly eat away at your buying power. Not only are you not earning anything, but you're actually losing buying power while you're holding that cash. So you really want your money working for you. That doesn't mean we have to have every dime that's not nailed down working for you. But it does mean that we don't want too much lazy money, because we need to at least be earning enough to keep up with inflation. Even if you feel like you have enough money today, if it's not earning for you, you might not tomorrow.
We're playing Financial Mythbusters here with Jake Floyd of Floyd Financial Group on Show Me the Money. Our telephone number 417-889-7233. If you'd like to sit down with Jake and have a casual conversation about your retirement and maybe bust some myths that you may have. Next myth is about long-term care insurance is your only option, Jake. Many people assume if they don't buy traditional long-term care insurance that they're simply out of options.
Yeah, so there's a lot of different ways to pay for long-term care. I'm a little bit different, that I would rather have your money making money and figure out which asset we want to use to pay for care if and when that day comes, rather than paying into a policy that we may or may not use and may or may not be there or be affordable by the time you actually get to that point. So I like to keep options open rather than nailing us into one strategy, but it really depends a lot on your situation, your health situation, your financial situation. There's long-term care, like traditional long-term care, where you pay a monthly premium. There's asset-based long-term care where you take, let's say, $100,000, it becomes $300,000 for the long-term care costs. But in a lot of cases, I think the math works out in a way where if we invest that money wisely, we might be better off than if you did either of those things. But it really depends on each person's individual scenario what would be appropriate. But long-term care insurance is not the only option. There's a lot of different ways to handle it.
So, Jake, if someone, let's say, is 62, 65 years of age and they do not have a plan for long-term care, is it too late to plan for it and to pay for it?
Definitely not. There's lots of things that we can do at that age. We start limiting options when we're more like 75 or if we're in failing health or things like that. There's certain types of trusts out there that can protect certain assets from long-term care costs. So again, it's really going to depend on your individual scenario, how much retirement money you have versus after-tax money, as far as what's going to make the most sense. But there are a lot of options, and if you want to talk to them, you come in and sit down with me.
And Jake, myth number 5, financial planning is only for wealthy people. I hear this one all the time. I'd meet with a financial advisor, but I just don't have enough money to do that. Is that a myth?
Definitely a myth. I think that most people, if you're worried about that, you're probably in better shape than you think you are. I've had people come in with a couple of $1 million to see me and say, hey, am I too small to sit with you? I got news for you. In Springfield, Missouri, if you got a couple $1 million, you're doing pretty good. And even if you're getting ready to retire and you got $200,000, $300,000, $400,000 in a 401k, depending on your lifestyle and everything, that can be plenty. If you are just starting out and you're 30 years old and you got 20 grand in a 401k or something, and you want a second opinion on how it's invested and everything, I'm happy to help with those people too. So I don't have minimums at my firm, as far as you don't have to have a minimum dollar amount to come see me. There's a lot of other firms that do. I put my pants on the same way you did this morning, so I don't view myself as too good to meet with people. There are certain thresholds that it probably makes sense to meet before it may make sense to hire me to manage money, because I don't want your performance to suffer because I'm charging you fees that are larger as a percentage because you have a smaller account. So I may just give you some tips, but I'm going to try to do whatever's in your very best interest, and really with no regard to whether I get paid, how much I get paid. I just want to do the very best thing to help you out. So if you want a second opinion on things, come and sit down with me. It's a very casual conversation. You don't need to bring anything. We'll send you a list of things. If you want to bring some things, just, here's what you can bring, but you don't have to bring anything. You can come in and just talk about things, see if you're on the right track, that kind of thing.
And as we always say, Jake, we'll meet you where you are here at Floyd Financial Group, and that number 417-889-7233. Next myth, Jake. Some people think estate planning is only for wealthy families.
Yeah, so this is definitely a big one, and everybody has an estate plan or lack thereof. And if you have no estate plan, that's still an estate plan. If you've been the child of a deceased parent or something like that, if there is no estate plan, that can make things very, very difficult, constrain family relationships, and at the very least, you probably don't want your kids to be fighting. So at least addressing some of the basics in estate planning, trust, wills, power of attorney, healthcare directives, TODs, PODs on bank accounts and titled things, it's definitely worth taking a look at. If you have some means, it will probably save you money to have a trust, and it will also give you some control that you won't have otherwise. But yeah, definitely everybody needs to have some sort of estate plan. If the only thing you have is a financial power of attorney so that somebody can help you pay the bills and access your stuff if you can't anymore, if you're incapacitated, that's kind of like the very bare bones you want to have. That's a very inexpensive thing to do. But you don't want to be on the backside of that, because if you don't have one of those and nobody can act on your behalf, then you have to go to the court and get a conservator guardianship over your stuff. And then you're going to have the court telling you how you can live your life, which you don't want, I promise.
Our next myth, Jake, is people often think retirement planning is something that you do once and you never revisit it, sort of a set it and forget it. I think retirement plan really needs to be flexible, elastic. What do you think?
I totally agree, Jeff. If I can have maximum return, maximum income, or I can have 95% of that number and have lots of options, I'm going to go with that one, because I think life is about choices, about having choices. I don't know what your retirement's going to look like, but I can promise you it will be different than you're envisioning. Life will throw you a curveball. And if you have no flexibility, it's hard to meet the needs in those moments.
And our final myth here of the 8 myths we talked about, Jake, is I can change Medicare anytime I want. It's one that people often learn the hard way. They think Medicare works like changing car insurance. Not exactly right.
That's true. Yeah, you have open enrollment periods. Unless you have a qualifying event, you have to stick to those. And those are very busy times. And trying to meet with a guy during open enrollment can be crazy, because those guys are running 20 meetings a day. If you go with an Advantage plan, you may or may not be able to switch back to a supplement based on pre-existing conditions they might exclude. There's a whole lot to think about there. And you definitely don't want to make a casual decision on that. And you want to make sure you're informed before you choose your plan the first time. But even after that, each year, it's probably worth revisiting and making sure you're getting the best deal.
We're talking with Jake Floyd. We're playing Financial Mythbusters on our show this week. Once again, want to remind you that retirement is simply too important to leave to guesswork or outdated advice. So before you claim Social Security, you enroll in Medicare, you make investment decisions, or create your retirement income plan, make sure that you're getting advice that's tailored to your life, not based on myths or internet opinions. Jake here and the team Floyd Financial Group are here to help you. You can schedule your complimentary retirement review today by calling 417-889-7233. That's 417-889-7233. You spend a lifetime building your retirement, so let's make sure that you have a plan to help protect it. And once again, that number, 417-889-7233. Jake, time for another break. When we come back, should retirees take less risk but not no risk? When our program continues here on 104.1 FM, KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about, should retirees take less risk but not no risk?
And Jake, for years, we've heard one piece of retirement advice over and over again. When you retire, you get out of the stock market and you move your money into safe investments. But according to some recent research from Morningstar, that may actually be one of the biggest mistakes that retirees can make. Why is that?
Yeah, so I would say that certainly if we're talking about over the last 20 or 25 years, that has been one of the very biggest mistakes that you could have made. Now, without the benefit of knowing what's going on and with the benefit of hindsight, that's easy to say today. However, we went through a very long period of safe money paying almost zero. From 2010 to 2022, CDs were paying like 0.25%. There was a little bit of fluctuation there, but I mean, it was very, very low. So like we talked about earlier, you might as well stick it in your mattress at that point. If you're going to do that, inflation's going to eat you up and you're going to lose earnings power, but you're also going to lose buying power. We want to have less risk, but we certainly don't want to have no risk, because no risk implies that we're going to be limited to whatever the safe rate of return is at the moment, which in today's world is maybe 3%, 3.5%. And we really want to be able to make more money than that.
So contrary to popular opinion, when you get into retirement, you still should have some risk, but it should be managed risk. Morningstar also points out that a lot of retirees, Jake, have become more heavily invested in stocks than they probably realize. How did something like that happen?
Yeah, so over the last 10 years, 15 years especially, bonds have significantly underperformed and stocks have gone up through the roof. So the bottom in 2009, since then, the market's up like 1,100%. Over that same period, bonds total return is something like 50%. And so if you had a 60-40 portfolio, your 60% is now worth probably 80% or maybe even more, simply because it's way outgrown the bond portfolio portion of your portfolio. And so this is where rebalancing comes in. We want to rebalance every so often. I'm not a big scheduled rebalance guy because I like to time rebalances based on what the market's telling us. But you definitely want to be rebalancing every year or two. We don't want to go a decade without rebalancing. That can be dangerous, and you end up in a much more risky situation than you think you are over pretty much any time period, not just the last 10 or 15 years, simply because stocks over the long term will outperform a lot of these safer assets. So it's important to look at rebalancing. Some people are like quarterly rebalance, like clockwork. I think that can cost you return because if things are on a run, we may want to let that run play out before we start rebalancing. So I'm more of a rebalance when it makes sense, not a scheduled rebalance kind of guy.
So, Jake, we're talking about taking risk when you're in retirement. You shouldn't take no risk, but some risk. And Morningstar says that this could be a good time for retirees and those approaching retirement to de-risk their portfolios. What does that actually mean, de-risking?
Yeah, so they're just saying, should we trim the stock market and buy some more bond exposure, take a little bit of the winnings off the table? You know, I don't hate that idea depending on the situation, but I will say that I believe, and again, if this is on the radio, it's on the internet. If it's on the internet, internet's forever, right? So here I go, making bold statements. But I believe we're at the beginning of one of the biggest runs the stock market has ever seen. And if that's the case, we don't want to get too conservative just yet. Not saying that we need to be aggressive. I'm simply saying I don't know that we should be running for the hills just yet either. This is why it's important to have a financial advisor who knows what they're doing and can help you make these decisions, because the biggest problem with an investor investing their own money is there's too much emotion. Everybody's afraid they're going to lose their money, or they're afraid they're going to miss out. The fear of missing out, FOMO, right? They're afraid that they're not going to buy SpaceX and it's going to go to 1,000 a share tomorrow. And emotion-driven investing is a very dangerous thing. So we want to be more calculated. We want to be cool. We want to be level-headed, and we want to be prudent. But that doesn't necessarily mean putting less risk into the portfolio. It depends on where you're already at. I mean, we definitely don't need to be super aggressive as we go into retirement. But, you know, if you're in a 60-40 portfolio and you're 65 years old, I don't know that we need to be taking the 60 and sticking it in the mattress either. I think we want to be, again, prudent, and we want to make sure that whatever we're doing aligns with your goals, your needs, and what's important to you.
Talking with Jake Floyd, Floyd Financial Group, we're talking about not taking risk in retirement, or should you take risk? It all depends. So, Jake, where do bonds fit into all this?
Yeah, so bonds are the traditional way to offset stock market risk inside of brokerage accounts and that kind of thing. So if we don't have it in stocks, most likely you probably have it in bonds. There are some other alternative investments out there, but those are kind of the big two categories. If we're not putting money into stocks, then buying bonds will help us to generate some return, but also to offset the risk of the money that we do have in the stock market. I personally think, as a continuation of what I just said about being prudent, I do think that bonds are positioned to be good for the foreseeable future. When interest rates are higher, if interest rates go down in the future and you already own bonds, your bonds appreciate. So the same thing that's working for us now is what has been working against us for the last 16 years or so, which is that interest rates were very low. And so when interest rates went up, our bonds got hurt. And that's how bonds have something like a 20 or 25% cumulative return over the last 10 years, which is awful. But every bloodbath turns into an opportunity after the bloodbath occurs, right? Like if real estate in this area went down 50% tomorrow, that'd be bad for you if you owned real estate. But if you were looking to buy real estate, it would be the opportunity of a lifetime. And so I think the bonds are in the same situation where they're going from the bloodbath to arguably a pretty good period for bonds over the next 10 or 15 years. So the old standby 60-40 portfolio is, in my opinion, looking better than it's looked in a long time.
Talking with Jake Floyd, Floyd Financial Group, we're talking about risk in retirement. Here's where some people sometimes go too far, Jake. If reducing risk is good, wouldn't eliminating then all stock exposure be even better in retirement?
Yeah, I think in the same vein of what we've been talking about here, I think the answer is definitely no there. The United States stock market is really the greatest wealth creation engine in the history of mankind. Even if we don't have direct exposure to it, we want to have things linked to it. It's the best way to offset inflation. It's the best way to grow your money over a long period of time, over proven history. Again, I'm not saying that history necessarily repeats itself, but if we look back at history, The United States stock market has just obliterated pretty much everything with maybe the exception of Bitcoin. That remains to be seen how that story will end. But, I think having some stock exposure is fine. And there are also ways to invest linked to the stock market without actually putting your money at risk through different types of annuities or other structured products that could make sense for some people if you're really more risk averse and we want to have some of that exposure, but we don't want to necessarily be in the stock market where we can get hurt.
So, Jake, if we have stocks in our investment portfolio once we're retired, the big question is, how much should retirees actually keep invested in stocks?
Jeff, that's really a case-by-case answer that we have to do. It really depends on what's important to you, how much you have saved, what your income needs are off of your investments. There's a lot more to it than that. But I would just say that very rarely would I say that people should have zero stock exposure. And also, equally rarely would I say we should have 100% stock exposure. The only exception to that would be if you're young and just starting out, then 100% stock exposure could make sense. But certainly when we're talking about retirees, that's probably way too much. It really is a case-by-case plan that we need to put together. And, if you're having these questions, you likely just need to come in and sit down and talk with us. Again, we'll just have a casual conversation. There's no big hammer going to drop on you. We're just going to talk about your situation and see if you feel like you're in a good spot. I'll weigh in and see if I think you're in a good spot, see what tweaks we might need to make as you approach retirement. If you're already in retirement, what we can do to squeeze as much blood out of the turnip as we possibly can, meaning as much reward as we can get for the amount of risk that you're taking. See if there's anything we can do to reduce fees, things like that. These are all things that are part of a healthy portfolio and a healthy retirement. So if you have not had those second opinions, come sit down with me. Let's talk it out over a cup of coffee.
And if you'd like to sit down over a cup of coffee with Jake here in the office, it's 417-889-7233. No cost, no obligation. Jake, if someone listening only remembers one thing from today's conversation, what would you want that to be?
I would say that retirement investing is not all about risk avoidance. Everybody doesn't need an annuity. Everybody doesn't need to have all their money in CDs because they're afraid. We need to take a little risk, but calculated risk. And we want to be able to have a well-rounded portfolio that's going to serve you in any type of financial weather. That plan needs to be built around the things that are important to you, not the things that are important to me or anybody else. It needs to be about what you want to do in retirement, what your needs are. Everybody has very specific, unique needs with their families or with their income situation or their health or whatever. And so all these things need to be taken into account before we can really make product recommendations of any kind. And I would just say, don't be too fearful because it can cost you a bundle.
Jake, great conversation. If you've retired or you're planning to retire in the next 5 years, right now is a perfect time to find out whether your investment portfolio is taking the right amount of risk. Too much risk can expose you to major losses, and too little risk can leave you vulnerable to inflation and the possibility of outliving your savings. If you'd like to sit down with Jake and talk about that very thing, again, no cost, no obligation, no judgment. 417-889-7233 is the telephone number. 417-889-7233. You can make the call right now if you want. Leave your name and number. Ashley will call you back during the week and set up that appointment for you. Once again, it's 417-889-7233. We're also online at FloydFinancialGroup.com. Jake, out of time for this week. I want to thank you for your time. But most importantly, I want to thank our great listeners here in the last bastion of sanity, Springfield, Missouri, for joining us. So for Jake, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.